Alrighty, so today's trade review is going to be on GBP and CD. So right now we're in my free Discord chat where I have this chart posted. The link to my free Discord chat will be in the video description. 100% free, doesn't cost you a dime to join. And again, that's in the video description. So right here we have a chart of GBP and CD that I posted. And you can see I said GBP and CD, bias is bullish. Daily market structure, that's what MS stands for. Daily market structure, 100% bullish. We recently came down into a higher time frame level of support, aka the old high inside of the fair value gap, and boom, nice reaction off that level, causing a lower time frame. That's what LTF stands for, lower time frame shift in market structure. Displacement there on the 4-hour, 1 hour with a 20 level inside as well. So we're going to break all this down in detail. And here are the 3 charts that I posted. Again, there is the, let's let it load real quick. There is the daily chart. So there's that old high I was talking about. It came down, boom, bounced off that. And this is the 4-hour chart where we had that shift in market structure with our displacement that created that fair value gap right there. Again, there's that higher time frame level or that daily level just displayed on a 4-hour now. See how it came down to that level? And then you got your reaction. And then I indicated that I think it's going to come down, trade it down into that, rebalance that price action, then come up and take out that buy side. And then this is just a 1 hour, which is basically the same deal. You can see we got the displacement. We have these sell stops right here that I figured it would want to target right at the beginning of that imbalance. We have this old high right here serving as support and the 20 level, right? So now let's go over to my charts. All right, so I'm going to clear this off completely and we're going to start from scratch, right? So daily chart, what does the market structure look like on this thing? Market structure is bullish, okay? Market structure is bullish. See how this thing is just consistently putting in higher lows. It's consistently tagging these highs. So it came up right here, boom, it tagged that high, and then we put in a swing low level, and it's consistently trending up higher right now. The momentum to the upside is clearly bullish on this daily chart, right? So we are trading with the larger time frame trend. So that's that. And we had a higher time frame level of support. What do I always tell you guys? It's so much better when the reaction off of a higher time frame level. Okay? Those higher time frame levels, the reactions that you get off of these higher time frame levels, there's something special. They're really nice, okay? So what did price end up doing? So on this daily chart, well, we topped out right here. So I want you to follow my cursor. Follow my cursor. See how price came up and then it tagged these highs right here. It cleaned out that buy side liquidity. What did it do after it cleaned out that buy side liquidity? It retraced lower, right? And it retraced into a discount. So if we take this low, look at my cursor again. From this low to that high, we have that price range right there. What we do is we take that low to that high, we measure it, and we find 50% equilibrium. This is, again, follow my cursor. See how where my cursor's moving? That's 50% equilibrium of that price range. Price traded lower below 50% of that price range. That is a discount marketplace. Okay, so I want you to think of it. A really simple way to think of it is like price was able to breathe, right? So think of price. It was ripping up. It took out this, and then boom, that's like hitting a brick wall. What do you think price is going to want to do? It's going to want to pull back. It's going to want to breathe. It breathed. It pulled back into a discount marketplace. And inside of a discount marketplace, we had a point of interest. That point of interest being the old high inside of the fair value gap. That old high right there inside of your imbalance. Remember our talks on high probability support and resistance. Whenever you have an old high like that inside of an imbalance, many times it is a very, very sensitive price level. It is respected immensely. So price pulled back below 50% equilibrium, aka in a discount marketplace, tested a higher time frame level of support, aka our old high inside of the imbalance. Boom, you get a nice reaction off of that level. So now we're going to go to our lower time frame so we can see that reaction. Here is our 4-hour chart. This is that higher time frame level now just displayed on a 4-hour time frame. So you can see price, it tested that level, Boom, you get a nice big explosive move to the upside. This is your shift in market structure. See how it broke that high right there? It came up, it broke that swing high level. And this is not only a shift in market structure, this is a high probability shift in market structure, which I've also made a video on if you just search my YouTube channel for high probability shift in market structure. What makes it a high probability market structure shift? Well, we have our displacement. And we have a strong close above that level as well, which helps too. So this is the displacement that I'm referring to. Right after we traded down into that level right here, it would trade lower, displacement to the upside. Okay, we have our fair value gap confirmation. There's our fair value gap confirmation. Again, I have videos on that. Just search my YouTube channel. I have several videos going over the fair value gap. The fair value gap is a necessity for me. I need that fair value gap because that tells me that there was a lot of buying interest in this particular point. Okay, there was a lot of institutional money backing this move to the upside, right? So we had that boom, that really nice strong move higher. That was our smart money footprint. That's what you want to look at it as, that smart money footprint. So then price ripped up, it cleaned out this buy side liquidity right here. And so at this point, we're bullish. All right, we've already established that we're trading with a higher time frame trend. We've already established that we're bouncing off of a higher time frame level. We've already established that we have this displacement to the upside and that shift in market structure. But do we want to buy right here? So we're bullish. We know we're bullish, but do we want to buy up here? No, I'm not a breakout trader. I am not a breakout trader. I'm not buying something in a premium marketplace. I'm not saying there's anything wrong with that. There's most definitely ways to do it successfully. But for me, I like to buy something when it is in a discount marketplace. So remember what I just said. What I just said a second ago on the daily chart, where we were measuring that price range and find an equilibrium of that daily price range. We've already concluded that price traded down into a daily discount. Well, same thing with the 4-hour chart here. We want to take this low prior to that strong surge to the upside, and we're going to take that Fibonacci to that high and see how price traded down into a discount below 50% of that price range into that fair value gap imbalance, right? That's what you want to wait for. We don't want to get FOMO. We don't want to chase price as it's ripping up, because more times than not, what's price going to do? It's going to pull back. Are those times where it's just going to keep ripping and you'll miss the play? Absolutely. But that's part of trading and you got to accept it. But most times you'll get a retracement. Price is going to want to trade back down into that imbalance. Why? Because it wasn't efficiently delivered. It's going to want to do so. Price is not like leaving that area inefficiently delivered. It wants to trade back down into that level. It wants to trade back down into a discount. It wants to accumulate. It wants to get more orders, right? And that's what we wait for. And boom, we get that pullback, right? So now let's go to a 1-hour chart as well to kind of narrow this down a little bit more. So you can see we came down, we took out these sell stops right here. It's that swing level, took out those sell stops, traded down into a discount. And so I said displacement there on the 4-hour, 1-hour, which we just talked about, with a 20 level inside as well. Now some of you are probably thinking, okay, what does that mean? What does he mean by 20 level? Like, what is that? Well, again, if you recall, if you've watched it, if you haven't watched it, I highly recommend you do. I made an entire series on support and resistance on here on my YouTube. And in one of the series, I can't remember which one it was, I talked about institutional price levels. Okay, so institutional price levels are 00, 20, 50, 80. 00, 20, 50, 80. Those are your institutional price levels, institutional levels of support and resistance. Most of your major market reversals, most of the points where price will have those major market reversals is also of institutional price levels. Okay, so we had our 20 level inside that imbalance. So where do you think I would be best to wait for price? Where's price likely going to find its bottom at? Where is it likely gonna more likely than not going to have its reversal off of? That 20 level. That's how you get precise with these entries. That's how you get really precise with these entries. And because it's inside the imbalance as well, we have this serving as a draw on liquidity, and then we have that 20 level inside of that fair value gap that it's going to draw down into. Okay, so that is a level of support. So what have we concluded so far? We're trading with a higher time frame trend. Check. We have a higher time frame level of support. Check. We got that reaction off of that higher time frame level of support. When I say reaction, what do I mean? I mean a smaller time frame shift in market structure, a smaller time frame displacement off of that level. Because I don't want to just buy something as price just comes down into that level. You can, and I'm sure there's ways to do it successfully. But for me, the easiest money, the lowest hanging fruit is waiting for that institutional money to come in and prove our thesis correct. Where's that institutional money? Right there, baby, right there. Boom, you get a nice move higher, displacement to the upside. That's our confirmation. That's what we want. There's that fair value gap confirmation that I want on my plays. Shift in market structure after it cleaned out that buy side, right? And now what do we wait for? Again, are we breakout trader? We don't want to grab it as it's breaking out. We want to grab it as it pulls back into a discount below 50% of that price range. It trades lower, cleans out that sell side, trades down into our imbalance, and tests our institutional price level, 20, right? And then what does it do? It rips up and it cleans out these highs right here, cleans out previous day's highs, which is a major liquidity pool. And it's also worth noting that previous day's highs, price had not taken it out yet. And I've had an individual on a few of my previous videos and on Twitter ask, is it best if price doesn't take out previous day's highs? And the answer to that question, as I've already said, is yes. It is absolutely higher probability when that level is left untouched, when that buy side liquidity is left untapped. It doesn't disqualify a play for me if it does take it out, like during London session, for example. It doesn't disqualify a play for me, and it doesn't automatically make me lose interest in the play, but it is without a doubt higher probability when that buy side liquidity pool, like today, being previous day's highs, is left untouched beforehand. Okay, that's higher probability without a doubt. So what is this? What are we looking at right here? This is what we call A plus trading setup, right? A plus trading setup. I mean, picture perfect, 2-to-1 risk reward on it. So it means you risk 1 to make 2. So I mean, just a beautiful play. I mean, we're trading with a higher time frame trend, higher time frame level, displacement. We didn't have London session backing us, so we were missing that. But I mean, other than that, just about everything really. We had just about everything, and I don't think it's done quite yet. I do think it's going to take out these highs. I could be wrong, but at the current moment, it's showing no signs of slowing down. So that's likely what we're probably going to tag next, these buy stops right here. But yeah, just a really clean play. Oh, and what was my stop on the play? Because we've already, like I just said, those highs was my PT, previous day's highs. But what about stop? Well, my stop was underneath of the fair value gap right here. The best place though to keep the stop would have been underneath these lows, because that's where we had that major liquidity grab, as you can see. That's where we had that major liquidity grab and then that displacement higher. So that's always going to be the absolute best place to keep the stop. But the vast majority of the time, you'll be all right using the fair value gap. That's what I used in this case. If I got stopped out, for example, and it was still within my kill zone and showed signs of curling back up, I can always reposition. But I didn't need to. It just perfectly played out. It rebalanced that price action completely, tested this level of support right here, and it just a beautiful move.